You know that feeling when you check your bank account on a random Tuesday afternoon and you see that number staring back at you and you think to yourself, I should have way more money than this by now? Like, you're doing everything right, you've got a decent job, you're not buying lattes every single day despite what the internet tells you, and yet somehow you're still living paycheck to paycheck while reading articles about people your age who just bought their third rental property. Yeah, that was me for way too long. And I finally figured out what the actual difference is. My name is Tom, and I spend way too much time thinking about why some people build massive wealth while most of us just kind of tread water financially our entire lives. If you're someone who makes decent money but can't figure out why your net worth looks like a sad joke compared to where you thought you'd be at this point in your life, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Here's the thing that nobody wants to admit out loud. The difference between people who get rich and people who stay middle class has almost nothing to do with how much money they make. I know. That sounds like something a motivational speaker would say right before selling you a course. But stay with me, because the actual mechanics of this are way more interesting than you think. A study from the Federal Reserve in 2022 found that about 33% of households earning over $200,000 a year have less than $10,000 in liquid savings. Meanwhile, there are people making $60,000 a year who are millionaires. That's not a typo. The math on this is absolutely wild when you break it down. Look, most people think investing is about picking the right stocks or getting in early on the next big thing. They think rich people have some secret algorithm or inside information that normal folks don't have access to. And sure, maybe some hedge fund managers do, but that's not what we're talking about here. What actually separates wealthy investors from everyone else is so much simpler and so much weirder than that. It's about what they refuse to do more than what they actually do. Let me paint you a picture. There's this concept in behavioral economics called loss aversion. And it basically means that psychologically, losing $100 hurts way more than gaining $100 feels good. Like twice as much, according to research from Daniel Kahneman, who won a Nobel Prize for this stuff. Normal people, and I was absolutely in this category, make every single financial decision through this lens of not losing. Rich investors have completely flipped this script in their heads, and once you see it, you can't unsee it. Here's what I mean. When a normal person has $10,000 saved up, they think about all the ways they could lose that money. The stock market could crash. That investment property could turn into a money pit. The business idea could fail. So what do? They keep it in a savings account earning 1% interest, which sounds safe until you realize that inflation is running at 3 or 4%, which means they're actually losing 2 to 3% of their purchasing power every single year. They're so afraid of loss that they guarantee a loss. It's absolute insanity when you think about it. But wealthy investors look at that same $10,000 completely differently. They're not thinking about what they could lose, they're thinking about the opportunity cost of not investing it. And this is where it gets really interesting, because opportunity cost is this invisible thing that's stealing your wealth every single day, and you probably don't even notice it happening. Let me give you a concrete example with real math. Let's say you have $50,000 sitting in a savings account right now, earning 1.2% interest. That feels safe, right? You're earning $600 a year. Cool. But here's what most people don't realize. If you had put that money into a boring S&P 500 index fund instead, historically, you'd average about 10% returns annually. I'm not talking about getting lucky or timing the market perfectly. I'm talking about the actual average return over the past 50 years. So on $50,000, that's $5,000 a year versus $600 a year. You're leaving $4,400 on the table every single year because you're afraid of something that might happen instead of dealing with something that is definitely happening, which is your money losing value. Now you might be thinking, okay, Tom, but what if the market crashes right after I invest? Valid question. And this is exactly the mental trap that keeps people poor. Here's the thing. Rich investors have completely reframed how they think about market crashes. And I'm going to tell you something that's going to sound backwards at first. They don't fear crashes. They wait for them. They plan for them. They get excited about them. There's this investor named John Templeton who made an absolute fortune. And he had this famous quote where he said, "The time of maximum pessimism is the best time to buy." This guy literally made his initial fortune by buying shares of every company trading under $1 during the Great Depression. Every single one. Even the companies everyone said were going to zero. And yeah, some of them did go to zero, but the ones that survived made him wealthy beyond belief. That's a level of conviction that normal people just don't have because they're playing not to lose instead of playing to win. But let's get tactical here because I don't want this to just be theory. Let's talk about what this actually looks like in practice. Wealthy investors do something that sounds absolutely reckless to normal people, but is actually the most mathematically sound thing you can do. They invest the same amount of money at the same time every single month, no matter what the market is doing. It's called dollar cost averaging, but that term makes it sound more complicated than it is. Here's how this plays out in the real world. Let's say you invest $1,000 a month into an index fund. Some months the market is up and your $1,000 buys fewer shares. Some months the market is down and your $1,000 buys more shares. Over time, you end up buying more shares when they're cheap and fewer shares when they're expensive, which is literally the entire goal of investing. Buy low, sell high. But most people do the exact opposite. They get scared when the market drops and stop investing, which means they miss out on buying shares at a discount. Then, when the market is roaring and everything feels safe, they pour money in at the top. It's backwards. I want to show you what this looks like with actual numbers, because this is where most financial advice videos just wave their hands and say, trust the process. But I'm going to show you the math. Let's say in January, you invest $1,000 and shares are $100 each. So you buy 10 shares. In February, the market drops and shares are now $80 each. So your $1,000 buys 12.5 shares. In March, it drops more and shares are $60 each. So you buy 16.6 shares. You're freaking out at this point because you've invested $3,000 and the market keeps going down. But stay with me. Then in April, May, and June, the market starts recovering. Shares go to $70, then $90, then $110. You keep investing your $1,000 each month. By the end of 6 months, you've invested $6,000 total, and you own about 72 shares. Now here's the magic. Those shares are worth $110 each, which means your 72 shares are worth $7,920. You've made $1,920 on a $6,000 investment in 6 months. That's a 32% return. And this happened because you kept investing when the market was down, not in spite of the market going down, but because of it. A normal investor would have stopped after February when things started dropping. They would have sat on the sidelines, watching their initial investment lose value, waiting for things to feel safe again. By the time they felt comfortable investing again, shares would be back to $110 and they'd have missed the entire opportunity. This is why wealthy people don't time the market. They just stay in it. Now, let me tell you about something that rich investors do that sounds completely insane to normal people, but it's actually the primary way wealth gets built in this country. They borrow money to make money. I know what you're thinking. Debt is bad. Dave Ramsey told me to cut up my credit cards and live on rice and beans. And look, if you're drowning in credit card debt at 19% interest, yeah, get that handled first. But wealthy people understand that there's a massive difference between consumer debt and investment debt. Here's a real example. Let's say you have $100,000 cash. You want to buy a rental property that costs $400,000. A normal person thinks, okay, I can't afford that. I only have $100,000. A wealthy investor thinks, great, I'll put 20% down, which is $80,000, and I'll borrow $320,000 at 4% interest. Now here's why this matters. That rental property generates, let's say, $2,000 a month in rent. Your mortgage payment is about $1,500 a month. You're cash flowing $500 a month, which is $6,000 a year. But that's not even the real return. The property appreciates at, let's say, 3% a year, which on a $400,000 property is $12,000. Plus your tenant is paying down your mortgage principal, which is another $6,000 a year. So your total return is $6,000 in cash flow, plus $12,000 in appreciation, plus $6,000 in equity paydown, which equals $24,000 a year. You invested $80,000 of your own money, and you're getting a $24,000 annual return. That's a 30% return on your actual investment. But if you had waited until you saved up the full $400,000 in cash to buy the property outright, you'd still be getting that $24,000 return. But it would be on $400,000 invested, which is only a 6% return. You'd be making the exact same amount of money, but tying up 5 times as much capital. This is what rich people mean when they talk about leverage. They're not just gambling with borrowed money. They're using other people's money to amplify their returns on their own capital. And here's where this gets even more interesting. While that rental property is doing its thing, you still have $20,000 of your original $100,000 left over. A wealthy investor takes that $20,000 and does the same thing again on a smaller property, or invests it somewhere else. A normal person would have used the full $100,000 on the property and felt good about not having a mortgage. One of these approaches builds wealth exponentially. The other builds it linearly. And over 20 or 30 years, the difference is absolutely staggering. According to research from the Survey of Consumer Finances, the median net worth of homeowners in the United States is about $300,000. The median net worth of renters is about $8,000. That's not a typo. 8,000 versus 300,000. And the primary driver of that gap isn't income, it's leverage. Homeowners use the mortgage, which is leverage, to buy an appreciating asset. Most renters didn't, and even the ones making good money ended up way behind. But let's talk about something even more counterintuitive that wealthy investors do. They lose money on purpose. I know that sounds absolutely backwards, but stay with me because this is actually brilliant. It's called tax loss harvesting. And it's one of those things that rich people do automatically that normal people have never even heard of. Here's how it works. Let's say you bought shares of a tech stock and it's down 20%. A normal person looks at that and thinks, well, I can't sell now. I'd be locking in the loss. I'll just hold it until it comes back. A wealthy investor thinks, great, I'm going to sell this at a loss, use that loss to offset my capital gains from other investments, which lowers my tax bill, and then I'm going to immediately buy a similar investment to stay in the market. The IRS has wash sale rules, so you can't buy the exact same thing immediately, but you can buy something very similar. Let me show you what this looks like with numbers. Let's say you made $50,000 in capital gains this year from various investments. You're going to owe taxes on that. At the long-term capital gains rate, that's about $7,500 in taxes. But you also have an investment that's down $20,000. If you sell it, you can use that $20,000 loss to offset $20,000 of your $50,000 in gains. Now you only owe taxes on $30,000 in gains instead of $50,000, which saves you about $3,000 in taxes. Then you take the money from selling that losing investment and immediately buy a similar investment. So you're still in the market, you haven't actually lost anything in terms of exposure, but you just saved $3,000 in taxes. That $3,000 can now be invested to make more money. This is free money that normal people just leave on the table every single year. There's another thing wealthy investors do that most people never even consider, and it has to do with sequence of returns risk. This is probably the most important concept in retirement planning that nobody talks about. Here's the deal. Let's say you retire with $1 million invested. You plan to withdraw $40,000 a year to live on, which is the classic 4% rule. Over the next 30 years, the market averages 10% returns, exactly like it has historically. You should be fine, right? Well, here's the problem. If the market crashes by 30% in year 1 or year 2 of your retirement, you're in huge trouble, even if it recovers later, because you're still pulling out that $40,000 to live on, which means you're selling shares when they're down, you're locking in losses, and you never recover from that. But if the market crashes in year 20 of your retirement, It barely matters because you've had 20 years of growth first. Same average return over 30 years, completely different outcomes based purely on when those returns happen. This is sequence of returns risk. And wealthy investors structure their entire retirement strategy around this in a way that normal people never do. They keep 2 to 3 years of living expenses in cash or bonds, super safe stuff, so that if the market crashes right when they retire, they're not forced to sell stocks at a loss. They live off the cash while the market recovers. This one strategy is the difference between running out of money at age 75 and leaving a multi-million-dollar inheritance to your kids. Now, let's talk about something that's going to sound borderline offensive to some people, but it's the truth. Wealthy investors don't diversify the way normal people diversify. Normal people think diversification means owning a bunch of different stocks or having money in stocks and bonds. Wealthy people think diversification means having money in completely different asset classes that don't move together. Real estate, businesses they own, commodities, private equity, intellectual property, royalties, all kinds of stuff that normal people don't even know exists. Here's why this matters. In 2008, the stock market crashed by about 50%. Bonds held up okay, dropping maybe 10%. If you were diversified between stocks and bonds like most people are told to be, you still lost a ton of money. But you know what went up during 2008? Certain types of real estate debt, gold, treasury inflation protected securities, royalty streams from music and books. People who own those things didn't just survive 2008. Some of them made a fortune because they were buying crash stocks from panic sellers. There's this statistic from Knight Frank that shows families with over $30 million in assets typically have less than 30% in stocks. The rest is in alternative investments. Meanwhile, normal people have 90% of their net worth in their house and their retirement account, both of which are in the stock market. One bad decade and they're completely screwed. The wealthy have built-in safety through actual diversification. Let me tell you about something called the capital stack, because this is how rich people really think about risk versus reward. Every investment has different layers, like a stack. At the bottom is senior secured debt, which gets paid first if anything goes wrong but has the lowest returns, maybe 4 to 6%. Above that is junior debt, higher risk, higher return, maybe 8 to 10%. Above that is preferred equity, even higher risk and return. And at the top is common equity, highest risk but also highest potential return. Normal people only ever buy common equity, the top of the stack. They buy stocks or they invest in the business as an owner, which means they're taking maximum risk. Wealthy investors spread their money across the entire stack. They'll lend money to a real estate developer at 8% interest, which is senior debt, super safe. They'll also take an equity stake in the project for potential upside. They're getting paid no matter what happens, and if things go really well, they make even more. This is how rich people sleep well at night while still building wealth. They're not betting the farm on one outcome. Here's something else that's going to blow your mind. Wealthy investors spend way more time thinking about after-tax returns than pre-tax returns. Normal people see that their investment made 10% and think, that's great. Wealthy people think, okay, 10% return, but I'm in the 37% tax bracket, so my after-tax return is actually 6.3%. Is that better than a municipal bond yielding 5% tax-free? Because 5% tax-free is actually better than 6.3% after tax in this case. This sounds like splitting hairs, but over 30 or 40 years, this is the difference between having $3 million and having $5 million. There's a study from Vanguard that found tax-efficient investing adds about 1 to 2% to annual returns. 1% doesn't sound like much, but on a $100,000 investment over 30 years at 10% returns versus 11% returns, the difference is $1,740,000 versus $2,290,000. That's $550,000 extra dollars just from being more tax efficient. Normal people never even think about this. Let's talk about something that might make you uncomfortable. Wealthy investors are way more willing to invest in things they don't fully understand, as long as they understand the people running it. This sounds reckless, but hear me out. A normal person won't invest in something unless they can personally analyze every detail and convince themselves it's a sure thing, which means they only invest in simple stuff they already understand, which means they miss 90% of opportunities. A wealthy investor thinks, I don't understand the technical details of how this medical device works, but I know the CEO has successfully built and sold 3 companies in this space. The board of directors includes experts I trust, and the market opportunity is massive. They invest based on trust and track record, not on their ability to personally validate every technical detail. This is how venture capitalists operate. They can't possibly understand the deep technology of every startup they fund, but they're really good at evaluating founders and markets. Now, this doesn't mean throw money at random things. It means wealthy people have spent time building a network of trusted advisors and learning how to evaluate people and opportunities, not just learning how to read a balance sheet. Normal people think financial education means learning about PE ratios and debt to equity. Wealthy people think financial education means learning psychology, networking, and how to evaluate character and capability. Totally different skill set. Here's one of the biggest mindset differences, and this one took me forever to understand. Wealthy investors think about money in terms of cash flow, not net worth. Let me explain why this matters. If you have $1 million in a retirement account, you feel rich, right? You're a millionaire. But you can't actually spend that money without massive penalties until you're 60 or older. You're asset rich and cash poor. You can't pay your bills with net worth, but if you have $200,000, that's generating $15,000 a year in dividend income or rental income or royalties. You have $300 a week coming in that you can actually spend. You feel way less rich on paper, but you're way more financially free in reality. Wealthy investors optimize for cash flow first, then let the net worth build as a byproduct. Normal people optimize for net worth, then are shocked when they're still stressed about money, despite having a decent balance in their retirement account. There's this concept called the income snowball that rich people build on purpose. Every time they get a chunk of money, whether it's a bonus or tax refund or whatever, they invest it in something that produces income. Real estate, dividend stocks, a business, whatever. That income gets reinvested to produce more income. Over time, the income snowball gets bigger and bigger without them having to work more. They've separated their time from their income. Normal people get a bonus and buy a nicer car, which is the exact opposite. They've just increased their expenses without increasing their income. One path leads to freedom, the other leads to a nicer prison. Let me tell you about something called phantom equity and carried interest, because this is how a lot of wealthy people structure deals in a way that normal people never even know is possible. Let's say you're brought in to help run a business. Instead of just getting a salary, you negotiate for phantom equity, which means you get paid as if you own part of the company when it's sold, even though you didn't actually put money in. Or if you're in real estate, you structure deals where you get a percentage of the profits above a certain return threshold called carried interest without putting in as much capital as the other investors. This is how people build wealth without having wealth to start with. They're using expertise and effort instead of capital. A normal person thinks they can't invest in real estate because they don't have money for a down payment. A wealthy-minded person offers to find and manage properties for someone who does have capital, and they structure a deal where they get 20% of the profits without putting in any money. Both people win. This is the kind of creative deal structuring that happens all the time among wealthy people, but never even occurs to normal people. Here's something that might hurt to hear, but it's true. Wealthy investors are ruthless about cutting losses. If an investment isn't performing, they sell it and move on, even if it means taking a loss. Normal people hold on to losers forever because selling feels like admitting defeat. There's even a term for this in behavioral economics. It's called the disposition effect. People hold losing investments too long and sell winning investments too quickly. Let me give you an example. You buy a stock at $50 a share. It drops to $30. A normal person thinks, well, I can't sell now. I'd be locking in a $20 loss per share. I'll just hold until it gets back to 50. Meanwhile, that money is just sitting there doing nothing, or worse, the stock drops to $20. A wealthy investor thinks, this investment thesis didn't play out like I expected. The money I have in this stock could be making money somewhere else. They sell at $30, take the loss, and reinvest that money in something that's actually working. Even if that new investment only makes 10%, they're better off than waiting years for the original stock to maybe get back to even. There's a saying in investing that your first loss is your best loss. Cut it quick and move on. But normal people can't do this emotionally. They turn every investment into a personal battle that they have to win, which means they end up holding bags while opportunities pass them by. Wealthy investors are unemotional about this stuff. Money is just a tool. Investments are just vehicles. If a vehicle breaks down, you get a new one. You don't sit in the broken one for 10 years hoping it fixes itself. Let's talk about something controversial. Wealthy investors don't save for emergencies the way normal people are told to. You've heard the advice, right? Save 6 months of expenses in a savings account for emergencies. Sounds responsible, but here's what wealthy people actually do. They keep 1 to 2 months of expenses in cash, and then they have a portfolio of investments that they could liquidate if they absolutely had to, but they never plan to. And most importantly, they have access to credit lines at low interest rates. Here's why this is smarter. If you keep $30,000 sitting in a savings account for emergencies, and you never have an emergency, which most people don't, that money earned basically nothing for 20 years. If you had invested that money and averaged 10% returns, it would have turned into $200,000. You just gave up $170,000 for the feeling of safety. Meanwhile, a wealthy person keeps that money invested, and if an actual emergency happens, they either liquidate a small portion of investments or they tap a home equity line of credit at 4% interest, fix the problem, and then pay off the line of credit over time while their investments keep growing at 10%. They're earning 6% on the spread. This sounds risky to normal people, but it's actually way more financially optimal. The key is you need discipline not to use that credit for stupid stuff, and you need to actually have the investments. But if you have those two things, keeping a giant pile of cash for emergencies that probably won't happen is just leaving money on the table. Now let's talk about the psychology of spending, because this is where a lot of people mess up even when they start making good money. There's this phenomenon called lifestyle inflation, whereas people earn more, they spend more, and they never actually get ahead. You get a raise from $70,000 to $90,000 a year. And instead of investing that extra $20,000, you upgrade your apartment and lease a nicer car, and suddenly you're still living paycheck to paycheck, just with nicer stuff. Wealthy people have completely rejected this. They practice what's called lifestyle arbitrage. They intentionally keep their expenses way below what they could afford and invest the difference. There are people making $200,000 a year, living like they make $80,000 and investing the rest. In 10 years, they're financially independent. Meanwhile, someone making $200,000 and spending $180,000 is just a well-dressed person who can't afford to quit their job. Here's a concrete example. Two people both get a $20,000 raise. Person A upgrades to a luxury apartment for $1,500 more per month and leases a BMW for $600 more per month. That's $25,000 a year in additional expenses. After taxes on that raise, they're actually going backwards. Person B keeps their same apartment and car and invests that entire $20,000 raise. At 10% returns in 20 years, that's $1,125,000. Same raise. One person bought a nicer temporary lifestyle. The other bought their freedom. The math on this is so obvious when you see it laid out, but most people never do the math. They just feel like they deserve nice things because they work hard, which is fine, but then they wonder why they're not building wealth. You can't do both at the same time unless you're making truly massive amounts of money. For most people, you have to choose, at least for a period of time. Do you want the appearance of success now or actual financial independence later? Wealthy people chose independence, and now they can afford whatever they want. Normal people chose appearance, and they're trapped. Let me tell you about something called the earn, invest, spend framework, because this is how wealthy people actually think about money flow. Money comes in, and the very first thing that happens, before anything else, is a portion gets automatically invested. Not after bills, not after fun stuff, first. Then bills get paid. Then whatever is left over is for spending. Normal people do this completely backwards. Money comes in, bills get paid, fun spending happens, and if there's anything left, which there usually isn't, maybe it gets saved. The wealthy framework ensures that building wealth happens first, automatically, before you have a chance to spend it on other stuff. This is literally the principle from the book The Richest Man in Babylon, written almost 100 years ago. Pay yourself first. But most people still don't do it because it requires a level of discipline that feels uncomfortable. You have to be okay with having less available to spend right now so you can have more later. Most people can't delay gratification like that, which is why most people aren't wealthy. Here's something that's going to sound harsh, but it's true. Wealthy investors are extremely selective about who they spend time with. They actively avoid people who are broke and have no intention of changing that because they understand that you become the average of the 5 people you spend the most time with. If your friends all think investing is gambling and buying lottery tickets is fine, you're going to unconsciously adopt those beliefs. If your friends are all reading books about business and talking about their investment strategies, you're going to level up. This isn't about being a snob. It's about recognizing that your environment shapes your thinking and your thinking shapes your financial outcomes. There's actual research on this. A study from the National Bureau of Economic Research found that if your peers are engaged in certain financial behaviors, you're way more likely to adopt those same behaviors. If your friends are all buying rental properties, you'll probably buy one too. If your friends are all financing new trucks they can't afford, you'll probably do something similar. Wealthy people curate their social circles intentionally. They join groups and clubs and masterminds where everyone is operating at a higher financial level, not to show off, but to normalize behaviors that lead to wealth. When everyone around you thinks investing 50% of your income is normal, it stops feeling like a sacrifice and starts feeling like just what you do. Let's get into something tactical that wealthy investors do with their actual investment accounts that normal people never consider. It's called an options collar strategy, and it's a way to protect your gains while still staying in the market. Here's the basic idea. Let's say you own a bunch of stock that's gone up a lot and you're worried about a crash, but you don't want to sell and pay capital gains taxes. You can buy put options, which give you the right to sell at a certain price, like insurance. But put options cost money, so to pay for them, you sell call options, which means you give someone else the right to buy your stock at a higher price. You've created a collar around your position. If the stock crashes, your puts protect you. If it skyrockets, you have to sell at the call price, but you still made money. And the whole thing was free because the calls paid for the puts. This sounds complicated. And yeah, you need to learn how it works. But this is the kind of risk management that wealthy people do automatically. They're not just hoping their investments go up. They're actively managing downside risk while staying invested. Normal people just white knuckle through market crashes and hope for the best. Here's another one. Wealthy investors use something called qualified small business stock exemptions. If you invest in certain small businesses and hold the stock for at least 5 years, you can exclude up to $10 million in capital gains from federal taxes when you sell. $10 million tax-free. This is literally in the tax code, but almost nobody outside of venture capital and startup world knows about it. Normal people work their entire lives and pay taxes on every dollar. Wealthy people structure deals to legally avoid taxes using rules that exist for exactly this purpose. Let me talk about the single biggest mistake I see normal people make with investing. They stop learning once they set up their retirement account. They pick a target date fund or whatever their HR department recommended, and then they just forget about it for 30 years. They never read another book about investing. They never learn about new strategies. They never optimize. Meanwhile, wealthy investors treat financial education like a part-time job. They're constantly reading, listening to podcasts, talking to advisors, learning about new opportunities. The financial world changes. Tax laws change. Investment vehicles change. If you learned about investing in 1995 and never updated your knowledge, you're missing out on decades of innovation. ETFs didn't exist back then. Robo-advisors didn't exist. Crowdfunded real estate didn't exist. Cryptocurrency didn't exist. I'm not saying you need to invest in all of that stuff, but you should at least know it exists and understand how it works so you can make informed decisions. Wealthy people know that the best investment is always in their own knowledge and skills. A normal person spends $300 on a new gadget without thinking twice, but won't spend $300 on a course that could teach them how to make an extra $30,000 a year. The math on that is insane. Spend $300 once, make $30,000 more per year, and that compounds over your entire career. But it feels like a cost instead of an investment, so people don't do it. Here's something about real estate that wealthy investors understand that normal people completely miss. The money isn't made when you sell. The money is made when you buy. If you overpay for a property, you can hold it for 20 years and still lose money. But if you buy it at the right price, you make money on day one, even if you sell it next week. Wealthy people will walk away from 100 deals to find the one that's actually priced right. Normal people get emotional and fall in love with a property and overpay because they're afraid of missing out. There's a real estate investor named Sam Zell who's worth about $5 billion. And he's famous for saying, debt is a sword, it cuts both ways. If you use it right, it builds empires. If you use it wrong, it destroys you. The difference is buying right. If you buy a property at 70 cents on the dollar and use leverage, you're going to get rich. If you buy at 110 cents on the dollar and use leverage, you're going to go bankrupt. Same tool, opposite outcomes, entirely dependent on the price you paid. This applies to stocks too. Wealthy investors are obsessed with valuation. They won't buy a great company at any price. They wait for the right price. Warren Buffett has literally said that price is what you pay, value is what you get. But normal investors hear about a hot stock and just buy it without even looking at whether it's overpriced. Then they're shocked when it drops 30%. They paid $100 for something worth $70. That's not bad luck. That's bad process. Let me tell you about dollar-weighted returns versus time-weighted returns, because this is critical and almost nobody understands it. Time-weighted returns are what the investment itself did. The S&P 500 returned 10% this year. That's a time-weighted return. Dollar-weighted returns are what you actually made based on when you put money in and took money out. And for most people, their dollar-weighted returns are way lower than the time-weighted returns of the investments they own. Why? Because they invest more money when they feel confident, which is usually when prices are high, and they pull money out when they're scared, which is usually when prices are low. There's research from a firm called Dalbar that shows the average investor underperforms the S&P 500 by about 4% per year over long periods. The S&P does 10%, the average investor makes 6%, even though they own S&P funds. It's entirely due to bad timing and emotional decisions. Wealthy investors have rules that remove emotion from the equation. They invest the same amount every month, no matter what. They rebalance on a schedule, not based on feelings. They have written investment plans that they follow mechanically. This is the only way to avoid self-sabotage, because your brain is wired to do the wrong thing when money is involved. Fear and greed make you buy high and sell low unless you have systems in place to override those instincts. All right, here's something that might change how you think about your career. Wealthy people don't just think about salary. They think about equity and ownership. If you're offered a job at $90,000 salary versus a job at $70,000 salary plus 1% equity in the company, which one do you take? Most people take the $90,000 because it's guaranteed. But if that company grows to be worth $50 million, That 1% is worth $500,000. You just gave up $500,000 to make an extra $20,000 a year for a few years. Obviously, not every equity offer is worth it. Most startups fail. But wealthy people are thinking in these terms. They're negotiating for upside, not just for salary. They're thinking about what the total compensation could be worth in 5 years, not just what it is today. This is how early employees at companies like Google and Facebook became multimillionaires, even though they were just normal engineers and product managers. They took equity seriously. And this applies even if you don't work at a startup. You can negotiate for bonuses tied to performance instead of just flat salary. You can negotiate for stock options. You can negotiate for profit sharing. Most people never even try because they don't know it's possible. Wealthy people ask for everything and see what they can get. Let's talk about the power of compounding one more time with a specific example that'll blow your mind. If you invest $500 a month starting at age 25 and average 10% returns, by age 65, you'll have $3.1 million. You invested $240,000 of your own money over 40 years, and it turned into $3.1 million. That's the power of compound interest over time. But here's where it gets really interesting. If you wait until age 35 to start, same $500 a month, same 10% return, by age 65, you have $1.1 million. You only delayed 10 years, but you have $2 million less. Those first 10 years accounted for almost 2/3 of your final total. That's because money invested early has the most time to compound. Now, if you wait until 45 to start, you end up with about $380,000 by 65. Still better than nothing, but you're investing the same amount per month as the person who started at 25, and they end up with 8 times more money than you. Same monthly investment, 8 times different outcome, purely based on when you started. This is why wealthy people teach their kids about investing early. Not because kids need to be managing portfolios, but because starting young is the biggest advantage you can possibly have. A teenager who invests $2,000 a year from age 16 to age 26 and then stops, never investing another dollar, will have more money at retirement than someone who starts at age 27 and invests $2,000 a year for the next 40 years. The person who started earlier put in $20,000 total. The person who started later put in $80,000 total. The person who started earlier still ends up with more. That's compounding. Here's the thing nobody wants to talk about. Building wealth requires you to be uncomfortable for a period of time. You have to live below your means. You have to invest money that you could be spending on fun stuff. You have to delay gratification. You have to make choices your friends think are weird. You have to say no to things you want right now for things you want more later. Most people aren't willing to do that, which is fine, but then they need to stop wondering why they're not wealthy. Wealthy people made a decision at some point that financial independence was more important than impressing people with stuff. They drove older cars than they could afford. They lived in smaller houses than they could afford. They skipped vacations and bought fewer clothes and cooked at home. Not forever, but for long enough that their investments could compound to the point where they didn't have to make those sacrifices anymore. 10 years of discipline bought them 50 years of freedom. But most people want both at the same time. They want to build wealth and also live like they're already wealthy. The math doesn't work. Unless you're making truly massive amounts of money, you can't invest enough to get rich while also spending like you're rich. You have to pick one, at least initially. And most people pick spending, then are shocked when they don't have wealth. It's not a mystery, it's just math. So here's what you actually do with all of this information. First, you automate your investing so it happens before you have a chance to spend the money. Set up automatic transfers from your paycheck to your investment accounts. Pay yourself first. Second, you educate yourself constantly. Read books, listen to podcasts, take courses, talk to people who are where you want to be. Third, you start thinking about every financial decision in terms of opportunity cost. That $5 coffee isn't just $5. It's what that $5 could become if you invested it every day for 30 years. Fourth, you get comfortable with leverage and debt used the right way. Fifth, you optimize for cash flow, not just net worth. And sixth, you build a network of people who think about money the way you want to think about money. This isn't complicated. It's just different from what most people do. And that's the point. If you do what most people do, you'll get what most people get, which is working until you're 65 and hoping Social Security doesn't run out. If you do what wealthy people do, you'll get what wealthy people get, which is financial independence and options. It's completely up to you. The information is out there, the tools are available. The only question is whether you're willing to actually do it.